Welcome to the Killick & Co weekly podcast on the 4th of August. Last week, stock markets started to correct slightly to the downside. This was despite very strong news on the US economy. This second quarter number for US GDP was anticipated to reverse that very weak period we saw in the first quarter of minus 2.9%. So the market was looking for 3% and that number came in at 4%. But it didn't do enough really to change the underlying sort of trend of the market, and that was that markets were starting to adjust down and volatility was beginning to rise. And we'll take a look at some of the charts and the impact on that. But first of all, a quick look at the diary for the week ahead. As you can see, it's still pretty much a full-looking diary as the US market continues to digest some of those second quarter corporate earnings. Last week, really one of the big features was Twitter, which caught the market slightly wrong-footed, and the shares squeezed higher by over 30%, encouraged by the user growth at Twitter. Looking to the week ahead, a few that we're going to highlight. InterContinental hotels, trading here has been strong, but the morning mutterings around InterContinental hotels continues to focus on the potential bid for this company. They have got activist shareholders who are trying to sort of stir some interest in InterContinental hotels, particularly this sort of newfound interest in buying UK companies, particularly for the tax advantages, and so there's a little bit of interest creeping in more speculatively into InterContinental. We also have Walt Disney, and we've been buying this company, or recommending the purchase of this company, based on the content that it owns, content being king at the moment in the field of online media. Looking further through the week, just really the key as we move into the sort of Thursday period is some of the European interest rate decisions. And we have the all-important Draghi conference that takes place on Thursday, and this comes after the rate decision of the ECB. So really a lot for the market to digest this week, and we should learn a little bit more, as I say, about the European economy, which I think is going to be quite critical going forward. So let's take a look at some of the charts. Starting with the 10-year yield, really just sort of observing the fact that this number that came out on US GDP temporarily pushed the US 10-year yield quite strongly higher, up to 257, the yield on the 10-year at one point. But interesting that it's reversed back again below 2.5% at the moment. So despite the positive news on the economy, I still think that the market overall is struggling to see this sort of current growth rate having longevity at the moment. Still concerns about the sort of longer term outlook for the economy at the moment, and hence that sort of yield not rising too aggressively at the moment, and seems like being sort of bought into on any signs of weakness at the moment. So still indications of plenty of money around for that type of return profile. Took into the markets, where you can see here the noticeable decline. This is the first real crack that we've seen in stock markets now for some reasonable period of time. We go back to sort of April. It's been a very steady trend higher, but quite a notable decline on it off the all-time highs. And really a sort of next move becomes quite important as to whether this is quickly absorbed, the selling pressure we've seen recently, or indeed that we're beginning a new trend. So I think the week's going to be important for technical factors as much as anything else. The Dow Jones itself has reacted more aggressively to the downside, and it's just interesting to observe that if we come back here really to the beginning of the year, that the Dow Jones now in the space of that week has reversed all of 2014's gains, now trades sort of flat on the year. That's more akin to some of the experiences we're seeing here in Europe. The FTSE 100 likewise is trading down around 1%. The FTSE 250 down about sort of 2 to 3% at the moment. So the sort of further you go down the market cap scale and the higher the risk, the lower the returns have been this year. So it's definitely, we're starting to experience a little bit of a risk-off period and starting to sort of find some of those safer havens. And that's the reason I think bonds are lifting up, and indeed we're also seeing some interest in the US dollar. I highlighted this chart last week. This is the US dollar versus a basket of other currencies, and you can see there the strength has continued in the dollar at the moment. So it's a real sense of some shifts in money at the moment. We've just got to find out how long this will last, and indeed whether there's any sort of discernible longer term trends that are changing here at the moment. The pound has been very much weakening off. This is more akin to, I think, the strength in the dollar we are seeing at the moment. There's nothing too much to worry about on the UK economy front. We've seen some slightly disappointing PMI data in certain areas, but nothing really to be too alarmed about at the moment. But nevertheless, it's notable that sterling is weakening from those sort of highs which it reached at 172. Some welcome relief potentially for the exporters that were beginning to feel quite a bit of pinch on operating margins. Just to talk through some stocks, well, Merck last week published numbers. We liked those numbers. It wasn't enough, I'm afraid, to enable some resilience against the underlying trend that we were seeing in weaker stock markets, but we're certainly pleased with the trend in Merck at the moment, and this is still representing some decent outperformance against some of the UK peers like Glaxo. Shell, on the other hand, is continuing to remain a very resilient stock to the upside. The numbers from Shell were very encouraging on all levels, so sort of 10% beat, particularly on the upstream business that Royal Dutch experienced last week, and the market is really buying into the sort of changing strategy at Shell and that sort of focus on minimising capex, increasing cash flow, and the dividend was increased by around 4%. And just really like the underlying sort of resilience of this share price chart at the moment. It's showing some good relative strength. This is the InterContinental Hotels chart, really just highlighting that the results will be published tomorrow, one which we still very much like, and possibly expect that this is going to be a bid candidate at some point. Rio Tinto, again, sort of continuing this theme that in the near term we do see some good relative outperformance by some of the mining stocks, and Rio Tinto has been publishing increasingly more positive noises around its iron ore business, which it's a major focus for them. So their results are due this week. But again, just take a note of that sort of price chart action at the moment relative to the market, and you can see it is a sector that is money is rotating into. Just finally, a chart on volatility. It has been noted for some time that volatility has been running at lows not seen for really decades, and this was down at the sort of June-July period, but a real spike beginning to generate in the last few weeks as stock markets are beginning to correct. As I say, the dollar is going up and bonds also going up at the moment. So volatility coming back into it. It may be just that August period that volumes remain low and some volatility can be introduced. So it's going to be slightly choppy conditions. Really, I think this week is all about determining whether these are sort of short-term technical trend changes, or we've got something here which is enduring more longevity to the underlying market conditions. So it's going to be a fascinating week. And for more live commentary during the course of this week, do follow me on Twitter, where we'll endeavour to keep you in touch with market developments as they happen.